Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. To talk about labor, the labor market. It gets a lot of press. That's sort of the rationale to encourage lowering interest rates because of a weak labor market. We'll talk about that. And how the stock market, bond markets, react to that. We have earnings now for the S&P 500. And an old financial adage I'm going to bring up at the end just for my own entertainment. Quick look at the numbers. Interest rates have all gone up. We meaning the Federal Reserve, the Federal Open Market Committee, has been lowering rates for whatever reason. The odds are about 50-50 that we're going to get another rate cut in December. Frankly, the pointless gesture has been made. We've already cut the cost of money half a percentage point. It's plenty. It's really having no impact on anything. It's helping keep the stock market up, which shouldn't be up. It's helped keeping interest rates kind of down, even though they've crept up again because the market's adjusting. And remember, we have sky-high home prices. So the gesture's been made. ISM numbers, well, the biggest side of the U.S. economy, the service side, is up. It's in a light expansion. Manufacturing, which gets all the press, is still kind of flat. Not contracting, just kind of flat. The service side is doing great. The rest of the economy fundamentally is doing great. Oil, of course, couldn't stay in the 60s very long. It's back down to 50. There's more about that later. This is the labor market. This is announced layoffs, so you can assume 30% of this actually transpires. Google's got a big number out there, Starbucks, a lot of people. The days of harboring employees after COVID are pretty much over. It's a lot more about, well, maybe we need these people, maybe we don't. And some part of that labor market, the private labor market, are looking for better jobs. They'll go if they can get a wage increase. That's where they go. The whole basic private labor market is in pretty good shape. What isn't in good shape is the federal side of the labor market. This is about 4 months old. Most of the people that are out making the labor market look weak are from government actions and whatever reasons, but most of them is on the government side or contractors to the government side, which is, as we know, a line item issue. So even though the Senate is talking about getting us back in a budget and the government back online again, maybe by Thursday, this is Monday, yay, the shrinking federal employees is not over. There's going to be more of that. U.S. private employment numbers are fine. The growth is on trend. This is kind of part of I don't understand what the problem is with the labor market. The Bureau of Labor Statistics, of course, is closed down. They're all on vacation. This is jobless claims. I can't tell you what the official jobless claims is, but it hasn't gone anywhere. It's probably moved sideways. I wouldn't assume up or down anything significant. There isn't that much drama going on in the labor market. The unemployment rate's 4.3. Maybe it's squeezed up to 4.4, maybe. We don't know. It's going to be a while until we get the actual numbers. But the labor participation, which is kind of the orange line here, well, it's creeping back up. People getting on the statistics side. Remember, unless you're looking for work, you're not part of any of these numbers. So there are people going back in the labor market. Participation level is going up. Great. The labor market, and this is kind of the important one, this is independent business and tightness in the labor market. They are both dropping. Jobs hard to get is dropping. It is simply not there. On the left side, pre-COVID, that's a tightening labor market. Hard to get jobs, that's the red, is moving along quite a bit. And the labor differential is real tight. Well, we're in a different kind of thing. We're having a loosening, more open labor market. You always want to look at how the consumers are doing if you think the labor market is in trouble. Well, here are delinquencies. They continue to be down. They're a teeny tiny bit above the historical lowest point, which was only a couple of years ago. No drama here. Here's the stock market. We had a good couple of days, sorry about the sarcasm, but a good couple of days meaning, the market tried to come down. We're simply overvalued. We came in with great earnings, but this is the forward PE ratio, the price to earnings ratio. It's a 23. That's extremely expensive, very expensive. It has no reason whatsoever to be up there. I mean, earnings, yay, look, they shot through the roof. Well, even shooting through the roof still doesn't justify the valuations where we are now, which is way past the roof. It's been past the roof for a while. God, great profit margins, over 12%. Again, we're overvalued, don't be surprised. Now that the elections are over and there's a minimum amount of, let's call it political drama going on. There's no economic drama, so there can only be the political side. Maybe before the end of the year, we'll get a nice correction. Just don't let it bother you. Those of you who watch the Fed like I do, and it's not that I recommend that you watch the Fed, it can be mind-numbingly boring. But basically what we have here is the red line, which everybody continues to say, that's Treasury debt. Well, it is technically Treasury debt. But that $30 trillion is the amount of money that's in the U.S. economy. Okay? Coming up on $30 trillion. And the other ones are the assets that the Federal Reserve has been selling since the aftermath of the money put in for COVID. And they've been doing a great job. They're getting rid of the stuff. They're letting it roll off. They're pulling money out of the system as much as they can. But we're still at $30 trillion of money in the economy. And just so you know, just a little while ago, even last week, the valuation of the S&P 500 and the U.S. stock market put its total valuation at $70 trillion, meaning the valuation of the stock market was twice that of the GDP of the U.S. It's a big number. That's $70 trillion. It's about 65% of the entire global stock market. It's also, if you're a Warren Buffett fan, one of his gauges that the market is too high. When the valuation is twice that of GDP or a little bit more, it needs to come down. All right, well, we've had that conversation. Oil market is in a glut. It is not just cheap, it's in a glut, and they're rapidly getting themselves not needing hip waders. They may need full dry scuba suits pretty soon because everybody's getting in the oil business. Even Brazil, I've mentioned Brazil a couple of times. Brazil has got a lot of oil, under 20,000 feet of water, but they figured some of that out, and they're going to get in the oil market. They're going to start pumping. The Israelis are starting. Everybody is getting in the oil market. And the people who have been in the oil market really got them on the map. Most of the Mideast OPEC members are saying, well, we better pump more because we need the money. We pump more and the price goes down. That's a tough spot for them. It's kind of like lowering interest rates, expecting the property market to get easier. It is a dichotomy. So oil is not going to change, and the number one really demand push in the oil market is China. And we're 2 years now with their manufacturing doing this. That's not going to change for the foreseeable future either. Finally, it was a roundabout question. There's a very old adage out there on the finance side of things. The term was America First. Well, it's been, adopted in some political arena. But America First was basically how you looked at global indices. The MSCI global indice, the orange down there in the bottom. The black up there is the S&P 500. Well, America First has been playing out for some time since COVID. If you look at all of the global indices, amazing number of them, they all have a U.S. component or companies of the U.S. in the index. Some of them look like they've been doing great. Middle East, all over the place. Well, you take that U.S. component out of all the indices, and that's what the rest of the world's stock markets have effectively been doing. The money's here. The investing is here. That's one of the reasons there's $70 trillion valued in the stock markets. Okay, well, here's where we are. We don't have a bad economy. We don't have an economy that needs fixing. We have some line items that need to be fixed in the federal budget, and we'll look at that again after we get them back to work. And we need a correction in the stock market. Embrace that. Okay, that's enough. Send questions along to info@SHA Wealth Advisors. I'm happy to deal with it. And I'll see you next time.